Hi everybody, welcome to the part 2 of the US Office REITs analysis. So in this video, I'll be going through two other new exciting REITs, which is Manulife US Reit and Prime US Reit. If you have been following closely, both REITs are actually badly hit with the share price being very low. With a low share price, essentially meant that the dividend yield would definitely be very high. But is it actually worth it to buy, or is there a lot of risk involved? So let us get right into it. So in this first half, as I analyze through the Manulife recent US results, I'll also give my opinions and what are the risks involved and why I'm not actually interested in buying it. So looking at their financial highlights, as you can see, net property income dropped by 3.9% year over year, which is common for all US REITs. Distributable income dropped by a significant figure of 17.4% year over year. Later on, we will analyze more and factor in what are the other things to take note of, because this value here is still quite minimal because they have actually included some other sum into it, resulting in a lower decrease. Occupancy rate actually dropped from 86.1% to 85.1%. MRES leverage ratio of 56.7%, which is above the 50% limit, whereas their unencumbered gearing ratio is at 60.2%, which included the divested property of 33 million amount. And of course, because of this, their property valuation has dropped by 14.6% because of the lower performance as well. So looking at a quick of their brief first half results, their gross revenue actually dropped by 0.8% year over year, net property income 3.9% as per the highlights, while distributable income dropped by 17.4%. So let's look at the reasons why. So lower rental and recoveries, which is common, higher property expenses, which is still going up, and higher financial expenses, of course, is common for all REITs because due to higher interest rate. However, what I want to focus on is their higher lease termination fee income. So this is not good because, as you can see here, it's a one-time off of 4 million, and it's one of their major tenants that actually cut their lease early and will terminate by the next year. So if we actually remove this 4 million from their distributable income this quarter or this half, the drop would actually be a significant higher amount of 26.1 million, because the distributable income instead of 37.9 million would have been 33.9 million. So this is a very important point to take note of. And of course, their distributable amount and DPU is insignificant because they are not allowed to give due to the high leverage ratio. So if we look at their assets, their net asset value is at a 0.40 cents US dollar. So I want everyone to take note of this. Although their NAV is at 40 cents, their share price is at a very low price of maybe around 5 cents. So because of this, it's very important for investors to know that do not always look at just the net asset value and the share price comparison and you just buy because it's at a very cheap price. There are reasons why some of the share prices are being sold at a lower price, because investors or other analysts notice that there are actually a lot of things that is happening within the REIT. There is, one, a very big risk, or two, there's a risk of collapsing. And of course, because of their high leverage ratio, that's why leading to a zero dividend given to shareholders. If we look at their debt maturity profile, there's actually a lot of debts that needs to be renewed within these 2 years. My concern is that their interest coverage ratio actually dropped from 2.9 times to 2.6 times. So this is an indication that their properties or the income that they're receiving is either dropping, or another reason is because their interest rate of debt is actually rising. Companies, especially REITs, run on debts. If the banks deem it to be more risky, the interest rate that they loan would tend to be higher. So same thing for Manulife US Reit. As they get more and more risky, their debts or payment when they loan naturally will get higher. causing them to pay even more for their debts. So if we look at their top 10 tenants, well, their highlight is because their major tenant, which is the children place, has actually cut short their termination or their lease. So there's a termination penalty of 4 million received from this tenant. However, the bad side is that this 3.5% of your gross income would sooner or later be removed. So this is one of the main concerns with Manulife US Reit. And from the next page, if we see the property valuation has continued to decline by a huge value of 14.6% year over year, or 6 months semi-annually. So expect it to continue to drop as tenants do not renew or they are unable to retain tenants. So now, from these results, why I'm not keen on buying the Manulife US Reit, or why it's a very big risk. So let me give you an elaboration on how companies tries to raise funds. So companies list themselves in the stock market is because there are one main big reason, which is to raise funds when it's required. So what are the common ways to raise funds? And let's see from Manulife US Reit point of view. So firstly, they can get money from sponsors, with sponsors buying their shares. Secondly is selling of assets, which is quite undesirable because selling your assets or your good assets will also decrease your income in a way. Thirdly, companies can issue more shares to the public market. Doing it will get funds in return, however, this will also dilute shareholders. For Manulife US Reit, the first pointer is actually removed because the sponsors cannot buy more than 10% or own more than 10% of the US Reit. Secondly, selling of assets is possible, but to me it's quite undesirable because it will, as I said, it will reduce the property income. And thirdly, is the only part where they are able to do it. However, if you look at the share price, it's quite impossible. Let's take an example. At the share price of 5 cents, in order to raise 143 million just to cover the 2024 debts, they will have to issue a significant amount of 2.7 billion amount of shares. And that's 147% of their current number of total shares. So because of this, it's very impossible for the management to actually raise this much amount of cash, as this would dilute shareholders, and shareholders would most probably reject this kind of opinion. So that's why when it comes to buying companies, it's always important to take note that even though the share price might be cheap, you must find out what is the main reason why these events are happening. And if the valuation is good and the company is stable, yes, definitely it's a good option to buy. However, for cases like this, there's a very high risk involved that Manulife US Reit might not actually sustain throughout this high interest rate period. If you like my channel, please hit the like, subscribe, and comment on what are your opinions with regards to the recent US environment REITs as well. You can also support my channel by clicking one of the links below in the description to support my channel. Thank you, and let us go on to Prime US Reit. So if you look at Prime US Reit's highlights, there's quite a few positive things to take away from this, because firstly, positive reversion of 9.5% with lease extension by their top number 1 tenant. So this is very important because big tenants now plays a big part in ensuring that property valuations of these REITs are able to sustain, because drop in property valuation naturally drops your assets, and that will actually cause your leverage ratio to naturally increase. So that's what's happening with Manulife US Reit. Of course, there's also risk with regards to Prime US Reit. That's why its share price has dropped significantly as compared to the other 2 REITs as well. As you can see, their leverage ratio has increased to 42.8%, with their leverage coverage ratio dropping from a Q1 at 3.8 times to 3.4 times. Although it's at a high level, it's still not as significant as compared to Manulife US Reit. In the later part of the video, I'll actually compare within their property valuation between the 3 REITs and the reason why Manulife US Reit is the unique one that has been experiencing gearing ratio limit being at such a high level. Next, as you can see, they have also refers to the JL report that I've talked about in my previous video, where office attendance rate has increased by 9% year over year. Net absorption rate has shows sign of inflection point. So this net absorption rate is the differences between spaces being available and the spaces being occupied. So this difference will give you the net absorption. So a negative net absorption essentially means that there's actually more office space being vacated, which is not good. However, the speed of it is actually slowing down, which means that people are actually occupying offices slowly. This is more elaborated in my previous video if you want to know more about it. So because of this, their financial results of course looks very bad as well, with the gross revenue dropping by 2.9% year over year. Net property income dropped by 7.2% year over year. However, their distributable income dropped by a huge value of 29.3% year over year. So let's see what is the main reason. And the reason is because of higher property expenses being one of the factors, and of course because of higher electricity, naturally these property expenses increases. One of the biggest factor is again because of higher interest expenses because of higher interest rate. And lastly, because managers opt for 100% cash instead of 20%. So why is this happening is because managers usually, or REITs managers usually do not opt for units when the share price are low, because if they opt for units, this meant that they will be receiving much more amount of shares, and that will actually further dilute the shareholders. So in the environment where the REITs share prices are low, usually managers would opt for cash instead. Similar to Manulife US Reit, their assets is actually at a net asset value of 75 cents US dollar. But if you look at their current share price, it's at a very low value of $0.12 USD. So this is a huge difference, and it's happening similarly for all REITs. However, if you want me to compare between Manulife Reit and Prime US Reit, Prime US Reit would definitely look like a more safer REIT as compared to Manulife US Reit, which can be reflected in their share prices. Of course, there's risk involved for Manulife US Reit, Prime US Reit, because their 2024 debts would have a huge amount that needs to be cleared or refinanced. So we have to observe more again, because refinancing during this period of high interest rate would definitely lead to a increase in their cost of debt, which is at 3.8% currently. So this is something to take note if you want to invest in Prime US Reit. So between these three REITs, I've actually came up with an idea to actually compare their property valuation changes throughout last year to this year. Because of high interest rate and the decrease in different performance, we can see how actually this property valuation has fluctuated. And as you can see from this table, within the three US office REITs, there's quite a difference in terms of performance. If you can see Manulife US Reit, from the first half of full year 2022 to now, there's a constant decrease of 19% semi-annually. Whereas for Keppel Pacific Oak and Prime US Reit, their valuation did not decrease that much, with Keppel Pacific Oak US Reit dropping 1%, following that increasing by 1%, essentially maintaining stabilization. Whereas for Prime US Reit, there was a decrease of 7%, following that an increase back by 1%. So these changes in property valuations sometimes can be due to sales of assets. However, for Manulife US Reit's example, interestingly, there's a huge drop is because of the performance of their properties. So that's why it's one big red flag in terms of why Manulife US Reit is getting badly hit, because their properties are not performing as well, with tenants not renewing or cutting off the lease early. This would definitely affect the performance of the properties, and lastly will affect their valuations. Of course, currently because of negative sentiments, these three REITs are actually priced at a very attractive value with very high dividend yield. However, it's very important to not only look at their dividend yield, but to compare on what are the management's actions and what they're doing in terms of managing their finances in order to make sure that the REITs is able to continue giving dividends and also sustain through this high interest rate period. Of course, all this analysis is just based on my opinion, and I do not have a crystal ball to know what is going to happen. So there are cases where if I'm wrong, Manulife US Reit might survive and perform much better. And if you are a shareholder that is more garang to invest at a share price of 5 cents, they may actually give a good return. However, as I said, there's huge risk involved, so please invest safely. If you like the analysis, please hit the like, subscribe, and comment on what are your opinions with regards to the US REITs. You can also support my channel by actually clicking on any of the links right down below. And if you are interested in listening to the part 1 of the video, you can actually refer here to see on what is the JIR report that I'm referring to and on Keppel Pacific Oak US REIT. Thank you, and to the next video.